Welcome back to the Deep Dive. Today we're looking at something pretty huge. The sheer amount of money, liquidity pouring into Southeast Asia. This isn't just a region that's growing. It feels like a really dynamic frontier. It's actively reshaping global supply chains and digital markets all at the same time.
It really is. The scale is fascinating.
Yeah, and we've got a great stack of sources today. Covers everything from like massive cross-border factory deals to the really fast-moving venture capital side funding these unicorns. So our mission today is pretty clear. We're going to try and unpack the big trends in foreign direct investment, venture capital moves, and also these strategic mergers that are really blurring the lines between industries. Okay, let's unpack this.
And what jumps out right away from the material is just the sheer breadth of the capital involved. It's not just one thing happening. You've got these two sort of parallel stories. On one hand, big institutional money, state-backed funds looking at huge physical infrastructure projects. And then on the other hand, you've got global VCs, growth equity, just funneling cash into purely digital businesses. The tension between those two, that's what makes it so interesting to analyze for you listening.
Okay, let's start with the macro view then. The FDI, the foreign direct investment numbers, they're pretty staggering, actually. In 2023, just looking at the six largest economies, Singapore, Indonesia, Vietnam, Malaysia, Thailand, the Philippines.
Yeah.
They pulled in a combined, USD $219 billion?
Yeah, $219 billion.
That's a huge vote of confidence, right?
Yeah.
From big institutions betting on the region long term.
It absolutely is, yeah. But we need to break that number down straight away. Because the distribution, it tells a slightly different story. Singapore, for instance, it's the established financial hub, the legal center, right?
Okay.
So it naturally stayed the top destination. It absorbed something like 73% of that total. Massive chunk.
Wait, hang on. 73% just in Singapore. That sounds,
Yeah.
well, it sounds like a number that could maybe paint a slightly skewed picture. I mean, how much of that $219 billion is actual productive investment, creating jobs, building facilities on the ground across the region, versus capital just kind of flowing through Singapore's efficient system for legal reasons or deployment elsewhere?
That's precisely the question. That's the critical lens we need here. A good chunk of that 73%. It reflects companies setting up headquarters, financial structuring, that sort of thing. If you really want to track where the physical growth is happening, the new factories, the greenfield investments, you've got to look beyond Singapore. You look at Indonesia, Vietnam, Malaysia. They're pulling in huge amounts of capital specifically for manufacturing, for the energy transition, for building out digital infrastructure.
Okay, so specifics. Where is that greenfield money actually going?
Right. Well, Indonesia is a big one for the EV battery supply chain. They're leveraging their nickel reserves, huge inflows there. Vietnam and Malaysia, they're expanding really fast in advanced manufacturing, semiconductor assembly, testing. This isn't just, basic factories, it's high-tech stuff. Strategic moves to build global supply chain resilience.
Got it. So the why behind this shift, this geographic spread, is really key. It's global strategy playing out. You've got this powerful mix. Companies needing to diversify supply chains, moving away from maybe just one country. Plus, you've got rising consumer spending within these nations. And massive investment, public and private, in basic infrastructure.
Yeah, exactly. It forces investors out of their old comfort zones, you could say. Pushes them directly into these emerging manufacturing hubs.
Okay, so you have this huge physical build-out happening, the factories, the infrastructure. That lays the groundwork. But does that structure kind of lag behind? Or does it actually enable the fast money,
right,
the VC side of things?
Oh, it absolutely enables it. That stable infrastructure, the growing middle class, it screams opportunity to VCs and growth equity funds. They're not just looking at it as a current market. They explicitly see Southeast Asia as a core, foundational, next-decade growth engine.
Yeah.
Even with all the caution we're seeing globally in the economy, the institutional money for tech in this region, it's still pretty robust.
Right, so where's that VC money focusing? What are the hot sectors?
It seems to be clustering around three main areas, but it's the innovation within them that's really attracting the capital. First, fintech. Still dominant, driven mostly by the just massive opportunity to serve the underbanked population across the region.
And when we talk about serving the underbanked, what's the tech solution they're actually funding? It's not just opening bank branches, is it?
No, definitely not. The real innovation is in the data. Often, traditional credit scoring data is thin or just doesn't exist for millions of people. So, investors are backing companies using clever AI, alternative data models, looking at mobile phone usage, e-commerce history, even bill payments to figure out creditworthiness. Plus, you've got this rise of embedded finance, B2B2C models, so payments, lending, insurance, it's all getting built right into other platforms like merchant apps or logistics software. Almost invisible finance.
Interesting. Okay, so fintech is one. What's the second area?
Second, lots of money flowing into AI and data platforms, specifically ones that automate key workflows. Think logistics, retail operations, financial services, moving away from messy manual processes. And third, of course, the big names, the consumer super apps. Your Grabs, CLTD, GoTo. They're still raising billions to expand their services. They're more than just popular apps now, though. They're also experts at navigating complex regulations and that massive user base. It acts like a huge moat, making it hard for newcomers.
That phrase, next decade growth engine, sounds really optimistic.
Yeah.
But let's, ground it a bit. We've seen reports, lots of sources talk about down rounds, cautious IPO markets, funding slowing down for late-stage VC globally. Is this long-term talk maybe just masking some current nervousness in the market?
I wouldn't say it's just rhetoric, but it's definitely, let's call it selective optimism. Investors are absolutely being more disciplined now. They see the potential, the demographics, the digital adoption rates, those are undeniable. But they also see the execution risk is really high. What we're seeing lately, the shakeout in the late stage market, it's probably a necessary correction. It forces founders to stop focusing only on growing market share at any cost. Now they have to show positive unit economics, a path to actual profit before they get their next big check. The VCs still bet on the scale eventually, but they want proof now.
Right. And the speed, the sheer disruptive force of all this tech capital, it forces the old guard, the established banks, the big logistics firms, the traditional retailers, it forces them to react fast. They often just can't innovate quickly enough internally. Legacy systems, corporate inertia, you know how it is.
So how are they reacting? What are they doing? Their response is mainly around strategic consolidation and collaboration. We're seeing it play out in roughly three ways. First, they're partnering like crazy with startups, trying to access specific bits of innovation they need. Maybe it's an embedded finance tool for their business clients or an AI thing to optimize their supply chain.
Okay, partnering makes sense. What else?
Second, we're seeing some pretty aggressive acquisitions of emerging tech companies. And this isn't always just about buying the product. Often it's about acquiring the talent, the engineering teams, the IP. You might see a big regional bank buy up a local payment startup, mainly to absorb their developers and basically skip years of internal R&D. Plus, they get instant market access sometimes.
Here's where it gets really interesting.
Okay.
Partnering, acquiring, and the third strategy, the corporate venture capital arms, the CVCs. That feels like the most direct, maybe defensive move. They're basically jumping into the VC game themselves.
Absolutely. Launching CVCs lets these giants think huge family conglomerates or major financial institutions compete directly for those early stage deals. It diversifies their own portfolio, sure, but it also gives them early eyes on potential disruptors. It's kind of a hedge against becoming obsolete, you know? They can play small experimental bets without putting their main business at risk.
Yeah, and all this activity just underlines what your sources are saying. The lines between industries are just completely blurred now.
Yeah.
It's not simply competition or collaboration anymore. It's like co-opetition.
Yeah.
It's both. A successful strategy today seems to demand that, say, a traditional logistics company needs its own digital platform, and it needs to embed financial services, and it probably uses data modeling from an AI specialist, and it partners with e-commerce players. If you're not connected, you're missing out.
That's it, exactly. The modern competitive advantage, the moat, is often the ability to connect different services seamlessly. Think about a local ride-hailing company that now offers loans to its drivers based on their performance data. A big bank might actually need access to that kind of high-frequency data to improve its own lending models. If you fail to collaborate in this environment, you risk getting pushed to the margins pretty quickly.
Okay, so all this excitement, all this money flowing in, it naturally leads to the big question, doesn't it? Is the VC market in Southeast Asia heading for a bubble? Is it just hype and too much money chasing too few deals? Or is it genuinely just catching up, reflecting real underlying economic opportunity?
That is the debate happening inside every global investment fund right now. And there are strong arguments on both sides. On the bullish side, you definitely have factors pushing valuations up, sometimes way up. There's a relative scarcity of really high quality, proven late-stage companies ready for big checks or IPOs. So there's competition for those deals. And you also have, let's be honest, classic global FOMO fear of missing out. Funds that maybe feel they miss the big growth spurts in China or India don't want to miss Southeast Asia.
Right, FOMO is powerful, but what about the risks, the potential downsides?
Oh, the risks or headwinds are definitely substantial, and then often quite specific to the region, which makes it tricky. We have to weigh them carefully. The sources highlight, first off, significant regulatory headwinds. And this isn't just about standard compliance. It's about very localized, often fast-changing rules around fintech, around crypto, and especially around cross-border data flows and data privacy.
Can you give us a practical example? Like, how does that regulatory risk actually impact a company on the ground?
Sure. Think about data localization rules. Many countries are now mandating that user data has to be stored and processed within that country's borders. So a tech company trying to operate across, say, 5 Southeast Asian markets suddenly needs 5 separate strategies for data compliance and storage. That dramatically increases cost and complexity. It's a real operational headache.
Okay, that makes sense. Regulation is one big risk. What else?
Second, geopolitical uncertainty. That looms pretty large. Specifically, the ongoing tensions between China and the U.S. are forcing companies and investors into strategic hedging. You see companies deliberately choosing to set up manufacturing in, say, Vietnam or Malaysia, not just for cost, but specifically to create supply chains that might bypass potential U.S. tariffs or restrictions on Chinese components. Investors sometimes feel forced to pick a side in that divided supply chain.
And the third major risk.
And finally, you just can't ignore currency volatility and the uneven economic recovery post-COVID. Some countries in the region have bounced back really strongly. Others are still struggling with slower growth, inflation. That directly impacts consumer spending power, business confidence, the overall stability that investors look for.
Okay, so if the risks, regulation, geopolitics, currency are that real, how are the sophisticated investors, the smart money, dealing with it? Are they pulling back?
They're not pulling back entirely, no. The capital is largely staying, but the strategy is definitely shifting. They're adapting. You see much stricter investment terms now, more focus on things like preferred stock structures, which offer investors better protection if things go south. And crucially, diversification is key. They aren't putting all their eggs in one basket, not betting solely on Indonesia or just Vietnam. They're spreading capital across multiple markets within the region to manage that localized risk, the regulatory twists, the currency fluctuations. It's portfolio management. And there's way more focus now on actual business fundamentals, those unit economics we talked about, rather than just chasing inflated growth numbers.
Yeah.
Hashtag tag outro. So I guess to try and wrap up this deep dive, the main takeaway seems pretty clear. Capital, whether it's big institutional FDI or nimble VC money, is definitely flowing into Southeast Asia. But it's flowing where the strategy really fits the specific regional context. The momentum draws the money, yeah, but success demands smart, localized execution.
Exactly. And the practical point for you listening is that just having a great product or a proven global business model, that's probably not enough here. You've got to look beyond the headline numbers, the big FDI figures, really understanding the local partnership landscape, navigating the specific compliance differences between, say, the Philippines and Thailand, getting the user behavior right, the trust models. That's just as vital as having plenty of capital. So what does this all mean?
Well, I think it means that, yes, money follows the momentum in Southeast Asia, absolutely. But if you want sustainable long-term success, you have to grapple with this blurred competitive reality we've discussed. If traditional banks are launching venture arms and tech platforms are offering financial services, who even is your competitor anymore? It's changed. Maybe the real strategic question for your business isn't just where you get your funding, but which complex local challenge you tackle first, wrestling with Indonesia's data laws or navigating Vietnam's currency controls. Because increasingly, your compliance strategy, your local alignment, that's becoming your real competitive edge. So the final thought maybe is, what specific local complexities are you currently overlooking in your own planning for the region?